Welcome to Talk Tickers. We cut through the noise of earnings calls.
Delivering insights for experienced investors.
Exactly. Today we're diving deep into 22nd Century Group's first quarter 2025 earnings call.
Right. We'll break down their performance, their strategy.
And give you the key takeaways you need. Let's jump in. How did the numbers look for Q1?
Well, sequentially, things definitely improved. Net revenue came in at $6 million.
Okay, $6 million. How does that compare?
That's actually a 50% jump from the previous quarter, Q4 2024. So pretty significant sequential growth there.
And what about gross margin? Still a tricky area for them, right?
It is, yeah. It also improved by 50% sequentially, which sounds great, but it was still reported as a loss.
A loss of how much?
$7.6 million. So better, but still in the red on the gross margin line.
Got it. Progress, but not profitability there yet. How about actual cigarette volume?
Saw a big increase there, too. Total cartons sold were 476,000.
476,000.
Yeah, that's up 41% from the 338,000 they did in Q4.
Okay, so revenue and volume moving nicely quarter over quarter.
Yeah.
Did they manage costs?
They did. Operating expenses came down to $2 million.
$2 million.
Which they highlighted as their lowest since, this whole turnaround thing started back in late 2023.
That's a positive sign. So how did that flow through to the bottom line? Net loss.
Net loss from continuing operations improved. It was $3.3 million.
Which translates to?
Per share. A loss of $1.89 per share.
Yeah.
Also an improvement.
Okay. And adjusted EBITDA. That's a key metric people watch.
Right. That also showed a significant improvement, a loss of $2.3 million.
Compared to?
Compared to a $3.9 million loss in Q4 24. So again, moving in the right direction.
And management's outlook on profitability?
They seem pretty confident. They explicitly stated they expect to hit P&L profitability in the latter half of 2025.
Okay, so the numbers paint a picture of sequential improvement, getting closer to break even. Let's dig deeper now. What's the context, the market dynamics they're operating in?
Well, it's a turbulent tobacco market, no doubt. You've got intense pricing pressure from the big guys.
Always.
Yeah. And a huge focus across the industry on nicotine delivery, whether it's combustibles or alternatives. Plus, you always have the regulatory overhang.
Right. So how is 22nd Century positioning itself in all that? What's their core strategy?
It seems to be a two-pronged approach. They're pushing their reduced nicotine premium products, the VLN brand.
Their flagship, really.
Right. And at the same time, they're building out their value-focused contract manufacturing, or CMO, business. That includes brands like Smoker Friendly and Pinnacle.
Okay, so hitting both premium, but low nicotine and value. Let's tackle the value brands first. Smoker Friendly, Pinnacle.
Yeah.
What's the play there?
So these are squarely aimed at the Tier 4 market segment.
Tier 4 meaning?
Meaning significantly cheaper, roughly, 2/3 the price of the big Tier 1 premium brands like Marlboro. It's about value for the consumer.
Makes sense in the current economy, perhaps. Are they getting these out there?
Distribution. They're working on it. Expansion into all 50 states is underway, but it depends on getting those state-by-state approvals.
Right, the patchwork regulation.
Exactly. And they're not just sitting still product-wise. They're introducing things like smoker-friendly Black Label.
Black Label, what's that?
It's pitched as a natural cigarette, trying to compete with premium natural brands, but still at a lower, more value-oriented price point.
Interesting. Tapping into that natural trend, but on value.
Yeah.
Any big distribution wins?
Yeah, the Pinnacle brand. They mentioned a deal with a top 5 convenience store chain.
Oh, really?
Yeah, looking to get into over 1,700 outlets in the second half of this year. That's a pretty significant footprint expansion.
Absolutely. So the value side seems to be about steady growth and wider reach.
Pretty much. They said the continued year-over-year growth there is driving profitability for both the retailers and for 22nd Century.
Okay, now let's flip to the other side. VLN, the reduced nicotine brand. This seems counterintuitive almost, given the industry's focus on nicotine.
It does definitely swim against the current tide, but their relaunch strategy is very specific.
How so?
They're targeting consumers who explicitly want to control or reduce their nicotine consumption, not necessarily quit smoking altogether right away, but manage the nicotine part.
Okay, a specific niche. How are they getting it to market?
They're leveraging their CMO partners, using those established distribution channels and the brand equity those partners already have.
So piggybacking initially.
Sort of. The idea is to build the VLN product within those CMO customer brands first, get it established, and then also build up 22nd Century's own branded VLN alongside it.
Creating a category almost.
That's the ambition, yeah, to create a separate VLN category in retail over time. And the key here, the real differentiator, is their FDA authorization.
Right, for the low nicotine tobacco itself.
Exactly.
Yep.
That gives them a unique position in the combustible market that the big players don't really have an equivalent for right now.
So while others focus on high nicotine alternatives, they're doubling down on low nicotine combustibles.
Interesting. What about the base CMO business itself?
You said high volume, low margin. How important is it?
It's critical, actually. It provides that steady, high-volume throughput, keeps the factory busy, utilizes machine capacity.
Even if margins are thin.
Yeah, because the volume generates consistent revenue and contributes to overall gross profit dollars, even if the percentage margin isn't huge. It's the operational backbone.
Okay. Did they mention volumes there? Any issues?
They had a bit of a dip late last year in 2024. They said it was because they repriced some customer contracts.
Renegotiations.
Right. But they said that trend is now reversing. Volume is coming back.
And the outlook for CMO volume?
They expect Q2 2025 to be, similar or maybe slightly growing, with more significant gains expected in the second half of the year.
Okay. So stability from CMO, growth potential from value brands and VLN. Let's talk financial health overall. We saw the improving numbers, but how are they managing things like debt and cash?
Yeah, they stress progress in restoring fiscal responsibility. Restructuring efforts are ongoing.
The goal being profitability.
Absolutely. P&L profitability late in 2025.
Yeah.
That relies on revenue growth, getting those gross margins up, and keeping a tight lid on costs.
And debt. They had some debt issues previously.
They've been tackling that. Using debt for equity conversions to reduce the principal balance, they said it's down to $3.9 million now.
That's a significant reduction.
Yeah.
What about cash runway?
They did a capital raise in late April, just before the call.
Okay.
And they stated that provides them with enough cash runway for the rest of this year.
So near-term cash crunch alleviated.
Seems so. One other thing on the financial front is that lawsuit.
Right, against Dorchester Insurance
Fair.
for business interruption.
Yeah, that's still ongoing. They mentioned a trial date is set for November 2025.
A potential wild card there. Could be a significant cash infusion if they win.
Could be, yeah. But obviously uncertain until it plays out.
Okay, so pulling it all together, what's their official guidance or outlook for the rest of 25?
They reaffirmed that goal. EBITDA break even in the latter half of the year.
Driven by?
Driven mainly by continued growth in the CMO business volume, maybe some pricing power returning, and then increasing contributions from VLN as that gets rolled out more broadly.
And they feel okay about their cash position now.
They said they're comfortable with the current runway after that recent financing.
So the priorities are clear.
Seems so. Hit P&L profitability, strengthen the balance sheet further. Those are the key messages.
And what about the FDA's potential low nicotine mandate? Is their strategy dependent on that?
They're obviously watching it closely, but they were careful to say their strategy doesn't depend on it happening. They see VLN as having potential with or without that broad mandate.
Okay. So wrapping up the analysis part,
Right.
What should investors really be keeping an eye on here? Key considerations.
Well, the sequential growth is positive, suggests the turnaround is gaining some traction.
Right, the numbers are moving.
And the strategy, focusing on both value and this unique reduced nicotine niche, offers some diversification in a really tricky market.
But execution is key.
Absolutely. Can they get those state approvers consistently? Can they really expand distribution effectively, especially for Pinnacle and VLN? That's crucial.
And the lawsuit.
Definitely one to watch. It's a potential, one-time boost if it goes their way.
And financially?
Just continuing to see that debt reduction hold, making sure the cash runway remains adequate, that builds confidence.
Okay, makes sense. It's a company in transition, clearly.
Very much so.
All right, let's shift gears. It's time for our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas stemming from this. What's first?
Okay, idea number one. Given 22nd Century's focus on that tier 4 value segment and all the talk about pricing pressure on premium brands,
Yeah.
consider maybe a long position in some discount retail chains. The ones really exposed to lower income, budget conscious shoppers.
Okay, long discount retail.
Paired with a short position in one of the major tobacco players that's heavily reliant on its premium cigarette brands.
The trade down thesis.
Exactly. The bet is that consumers increasingly shift down to value brands like Smoker Friendly, benefiting the discount stores where they're often sold, and hurting the premium brands' volumes or margins.
Interesting. A macro play linked to their strategy. Okay, what's the second, maybe riskier idea?
This one leans more into the VLN angle. 22nd Century has this unique FDA-authorized, very low nicotine cigarette.
Right, the differentiator.
So thinking longer term, maybe anticipating potential regulatory shifts towards nicotine reduction or just growing consumer interest, even if it's slow.
Okay.
Consider a speculative long position in 22nd Century itself, acknowledging it's a smaller, riskier stock.
Long XXII on.
And sure, a major tobacco company whose future strategy is really heavily invested in high nicotine non-combustible products. Think like nicotine pouches or similar things.
So betting against the high nicotine alternative trend.
In a way, it's a bet that maybe, just maybe, the future could swing towards nicotine reduction, even in alternatives, giving 22nd Century's approach more relevance, while creating headwinds for those all in on high nicotine delivery outside of traditional cigarettes.
Very speculative, but I see the logic. A contrarian bet on the future of nicotine.
Precisely. Contrarian and definitely outrageous but plausible territory.
Absolutely. And we have to stress again, these are not financial advice, purely thought experiments. Do your own research, please.
Absolutely. Thorough due diligence is essential.
Okay, that wraps up our deep dive into 22nd Century Group's Q1 2025 earnings call.
We've hit the key financials, the strategic moves in value and VLN.
And provide some context and those speculative trade ideas for you to ponder.
Their progress on the financial front and expanding their reach definitely warrants keeping an eye on them.
For sure. As always, we love getting your feedback. Let us know what companies, what sectors you want us to dive into next time.
We'll see you on the next Talk Tickers.